Hey everybody, it is Tuesday, October 29th after the close. I'm taking a quick look at the S&P 500 as you get ready to trade Wednesday, October 30th, and the Fed. The Fed statement comes out at 2 o'clock and the press conference starts at 2:30. So everybody, the media and the futures that price in the Fed funds futures are pricing in a rate cut for tomorrow, but that we will probably go on pause after that. And people are starting to get a little worried now about what Powell might say at the press conference. Um, we're taking a look at the simple daily chart here with all the price levels removed off of it. These little yellow arrows I added just to point out the last three Fed meetings. Um, Here was the last one here in September. We traded about 30 points top to bottom. The one on July 31st was a much bigger range and more bearish. We traded almost 60 points. And the one in June was really sort of had a lid on it. We only traded about 29 points top to bottom. So when we average these together, we get about 39 points. We could go that route. But what I'm kind of seeing is that what happens is it looks like the market takes a shot at 1% total range, top to bottom on a Fed day. So you had a 1% range here and a 1% range here. But this day you did about a 2% range. So if he says something that gets the market uproared a little bit, maybe it's a 2% day, whereas you'll get about a 60-point range or more. I'm pretty sure the December Fed meeting last year. I don't want to make it dizzy and roll the chart sideways here, but I'm pretty sure the one in December was bad. It was probably like a 3 or even 4% day, top to bottom. It was probably something crazy like that. Anyway, that's where I think we get this average that we can sort of try to shoot at. And you can see here when we had this really very well contained range back in June, we wound up with a back end move where we moved up higher over the course of the next two sessions, and it looks like we made an interim all-time high here. In fact, after that Fed meeting, and then sold off a little bit from there, and then moved up again. So if we are going to go 30 points top to sideways, my only concern is that we're going to come down and we're going to end up poking down through the 10-day simple moving average. This is rising pretty quick. This is going to be up around 30, 14, or 15 tomorrow. So unless we open and set some kind of a high on the day up, around 30.45 or so, 30.44, 45, a 30-point move, a 1% move back down from there would take us on and the problem with that is that you can see here what happened, the last time we took our first little poke down through the 10-day simple moving average. The next day we made another high and then we rolled over and sold off from there. Back here, when we took a little poke down through it the day before the July Fed meeting, and then we sold off from there. Back here, though, after this Fed meeting, we traded up, we came down, we made a little poke down through it, messed around for a while, and then rallied up. So this was an exception. We were probably in a much more bullish, phase right here. I think we were probably, looking forward to possibly, like a China trade deal working out or some nonsense like that was going on back in June. I don't recall right now, but things were different. Now, any kind of little false move like this winds up making the market roll over. And it's not that I am so blindly bullish that I just want to see us rally. I just want to see us get out of this stifling range that we're in where nobody makes any money on their long-term capital. If you keep topping out at the same point and then pulling back down to maybe 2,700, 2,800, there's never a deep enough sell-off for people to get in a good value buy on stocks. And then by the time we turn around and move up, we're already halfway through the rally by the time people get on board, and then we just sort of top off, peter off, and fall down from there. It would be better for us to get out of this range, and we've already sort of started that. We really have a good, strong start, foothold here to try and leap up and move forward and get up above to around 3,150, 3,200, and then if we pull back from there, back down to 2,800, 2,900, back testing this low here from October, then that would be a terrific pullback that people could get on board with, and we could buy and then have a good rally up from there. It just seems like the market isn't fully getting extended and isn't fully pulling back either. So that would be, that's my rationale for why I think it would just be better to just go on and move ahead and make that high now, make that new high significantly a good solid 100 to 200 points higher from where we have been topping out. One other thing I wanted to say before I shut down the video here is that speaking of this October low, now that we've set a new all-time high from this becomes a far more significant level than we realized. For a while there, it really was sort of like a dream state. It didn't really seem like this was meant anything and that it could possibly hold, that we most definitely come back and back test it and probably break it. But now it is like a very significant level because we made a new all-time high after it. So we can add on percentages to here and so on and so forth and try and figure out where we're going to get up to the next all-time high. And I think on the list of levels that I gave you, the top level that I gave you was 31.41, and I believe that's a 10% move off of this low. So that just gives you an idea. If we were to maybe go a little above, overshoot that to 12 or 13% above this low, or even go to 15%, you can add that up yourself, but that's how we would get to that 3,200. So we're pivoting off of this October low for Q4. Okay, that's it. I hope this video helped you, get yourself in gear for tomorrow and help you make some better, more informed and less nervous decisions tomorrow for the Fed. Have a great evening. See you tomorrow.